Hi, I'm Kep Kepner CPA here in Dallas. We're talking about my client. I'm calling him alias Roger, and alias Roger had 900,000 of taxable income in 2014 and ended up paying almost 300,000 in tax, including penalties for late filing, late paying, and underpaying, and then he was charged interest on the money that he didn't give to Uncle Sam. So he was upset about all the tax that he owed. And we've been talking about strategies that he has. So one strategy that people use traditionally in tax planning has to do with determining what year you take various deductions or what year you recognize income. So let's say you're in a business that constructs things, maybe a construction company, maybe a software company. Well, if you receive money in advance from a customer, say you need that money so that you can buy materials to work on their product, then the question is that really income to you? Well, it may or may not be. So if it's not income to you, it's a liability. And it's a liability because you have to go out and perform the work before you really earn that money. So if you're at the end of the year and you can take some of this cash that you get, even as a cash basis taxpayer, and determine that some of it is really not earned, then perhaps you don't have to pay tax on that, and you can postpone that to the next year. Let's take another example. Some of you are familiar with the people that are tax advisors. They're called automobile dealers, who are trying to tell you that you can buy an expensive car and use the 179 write-off method and write it off in the current year. Well, there are several conditions about that. One is you can write off only the business portion. Secondly, that vehicle has to be over 6,000 pounds. And third, it can't be sitting in the dealer's lot. You have to buy it and use it before the end of the year. So let's say you depreciate that $50,000 vehicle. So this year you get a $50,000 write-off. The next 5 years or 7 years, you're making payments on that vehicle. And so you're spending cash, but you don't get to deduct that because you've already deducted the cost of the vehicle. So there's an example both on the revenue side and the expense side where you determine what year you're going to report that income. So let's say that you're in a growing business, and this year you compute your liability for unearned income to be $100,000. Well, that means that this year you don't have to pay tax on that 100. But what happens next year? Next year, maybe you have growth and you have higher income. So now you're still going to pay a high bill because you're going to pay tax on this 100 from this year plus your income for next year. So you make the same calculation at the end of the year. Well, maybe there's only 200,000 that's unearned. And so people get into a trap. They postpone their income, reasonably so, because they haven't earned it. But then, as they grow, maybe their tax bracket increases and they earn more money, so eventually there's a day of reckoning. And what happens in that kind of basis, when the revenue falls off, the taxable income reduces, and you have to take that into revenue at that time, maybe that's when you don't have as much cash because business is off, and then you got to pay more tax. So timing is a big part of when you recognize income and recognize expenses, and it's a ongoing kind of strategy that you need to implement throughout your business so you know these and understand these kinds of techniques. You don't want to commit any kind of tax fraud, of course. You want to manage your business the best way possible. If you need help with that, we can help you, so give us a call. Thanks.